One thing that can scare both new investors and seasoned investors is the concept of risk. Many times we don't get involved in certain strategies or in certain markets because we think they're very risky, or we don't have a healthy respect for risk, and so we jump off and take too much risk without realizing we don't need to take that much risk. If those are concerns and questions that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. One big area when it comes to the stock market is the concept of risk. Human beings like to bet on anything that moves. We bet on dogs, we bet on horses, we bet on sporting events. Well, we also bet on the movement of stocks and all of the other markets that are involved in the financial markets. So if it can move, somebody is going to be betting on it. It's possible to bet on the weather, when famous people may die, sporting events, horses, dogs, as I mentioned, and pretty much anything that moves. We not only have car races, we have truck races, and we have different kinds of car races. And people just love this. They love that competitive spirit. They like the ability to pick a favorite and then have that favorite actually go on to win. We get great satisfaction out of that. It is also possible to bet, quote unquote, on companies. Now, a lot of people that are involved in the stock market, yes, they're betting. That's gambling. What I teach in my program is not gambling. We have a very careful strategy that is applied to you and that's tailored to you. And we're not always going to be right, but we're not assuming a lot of the risks that a lot of market participants will assume. Many people feel that the stock market is just a legalized form of gambling. And for most, that is true. You're just throwing money into the market just to see what will happen. And if you win, fine. If you don't, fine. That's kind of like my attitude when going to Las Vegas. I'm there to just have some fun. I don't really anticipate making any money. Now, there's other people that treat that as very serious business, and they would consider me to be not a serious gambler. And I'm kind of glad they don't do that because I don't gamble. This can be true when it comes to the stock market, especially when you act on tips or some kind of get-rich-quick method. This is one of the reasons I've come out with my program is, first of all, I am an educator. Secondly, I know a lot about the stock market and have a lot of years of experience in the stock market, so I want to combine those two together and be able to teach this skill to other people, where you think for yourself. You don't rely on some cousin or some friend down the street to say, yeah, you should buy some of this company. It's going to go up. That may be a stock tip, and you may act upon that, but is that really wise investing? What's really disheartening is when somebody gives you a tip and you don't act on it, and then it goes up. And you're thinking, why didn't I do that? It's because you have no plan. Good investments will come to us if we develop the right strategy. We don't need to necessarily go and find them. And I know that goes contrary to the way a lot of you do things. If you set up your criteria beforehand and then wait for things to develop, that gives you a much more high probability of seeing success. There are different risk tests, and I'm kind of involved in putting one together myself, but there's a lot of tests online, so I don't really give one myself. What I do is I ask a lot of questions. When anybody ever becomes a member of my program, we spend some time together if they want to, where we talk on Skype or on Zoom or on the phone or any method that's best, and we get to know each other. I ask a lot of questions. The other person gives a lot of answers, and together we say, okay, this would be a good plan to start off with. I think the plan that I have would be a good answer to what you're trying to do. Also, many times I've said, I don't think the program that I have is really what you're looking for. You may want to go somewhere else. So I'm pretty picky about the students that I bring on board to my program. So there are many risk tests that you can take online, and they're free. A lot of brokerage outfits will have a risk test just to kind of give you some things to think about. Tests will vary from person to person. One person may like taking on risk. They get a lot of thrill from that. Other people, they don't want to take on any more risk than they absolutely have to. And then everywhere in between. Also, the results will be different for each person. One person's thrill is another person's anxiety attack. And so each of us have a different way that we approach the markets. We're in different scenarios in our life. We're at different stages in our life. And so what is risky to one person may not be risky to another, and vice versa. Risk tolerance can change over time. If you're 20 years old and single, you don't invest the same way that if you're 60 years old getting ready to retire. Or if you're building a family and you have a mortgage and you're developing your career, you invest differently than when you were 20 years old and single. So things can change. Also, what is your work situation like? Do you have the ability to be near a computer or have a smartphone with you where you can check on things? If you want to be more of a short-term trader, you need access to information. If you're a longer-term investor, you don't have to check things as much. And then market conditions naturally can change. There are periods of time when the market goes up, when it goes down, and when it goes sideways. We need to evaluate where we are at any given time and then say, what are the opportunities that are available to us? A lot of investors, they want to just prepare for the downside. They like it when the market goes up, but they're really concerned when the market goes down. They're afraid of losing what they have already gained. Where other people say, oh, that's an opportunity to make some more money. So everybody's going to be a little bit different. In summary, risk is very fluid. It changes, and it can vary based on the type of person that you are, your current climate, where you are in life, and different time horizons. Are you investing now for some point in the future? Are you investing because you want to generate additional income? Are you looking at doing this full time? Is this just a hobby of yours? Do you want to make money from the stock market with the hope of paying off your mortgage or getting out of debt or buying a second home or starting a business? Everybody's going to be a little bit different. And when will you need that money? Do you need it 6 months from now, a year from now, or 20 years from now? That will play in heavily to the different types of strategies that you can implement and the different levels of risks that you are willing to take. So how do we determine risk? Each person has a risk level. We all do. Some people consider themselves to be fearless, the old Evel Knievel type. He was scared to death, if you know who he is. But he was willing to take on risks, and that made him an awful lot of money and made him very famous. Where other people, they like to watch those things, but they would never actually do that themselves. Some people get a real charge out of climbing mountains. Other people get a real charge out of sitting in a hammock on the beach. That's their idea of risk because they're outside instead of inside. Different people have different levels of risks that they are willing to assume, and there's no right or wrong answer to this. The one thing that can get in your way sometimes is fearing the unknown. We tend to fear that, and some people, if you tell them something that they don't really know much about, their immediate answer is no, or they're skeptical, or you have to prove it to them. That can get in the way of some really good opportunities. It can also shield you from some really bad opportunities at the same time. Some people are willing to take on more risk while others want to take on less risk. And only you can answer this. And it's going to be different. And there's no right or wrong answer. What is your comfort level? Now, as you gain more knowledge and as you learn things and as you watch things, you'll gain more and more confidence in things. And you might be willing to take some risks that you weren't willing to take just a few years ago. What we want to do is avoid desperation. If you get into the stock market because you need to make money, it's probably not going to happen. But if you want to develop a skill that you can refine and grow into over a period of time, then the stock market can be a very good vehicle for doing that. The general rule of thumb that I use is if you find yourself thinking about this a lot, or if you're losing sleep over something, you've probably assumed too much risk at that point. Now, it's very common to have trouble sleeping. We have things at work. We have things in our family that we're thinking about. But if you find yourself dwelling on different investments or trades that you have and fixating on them too much and you're worried about them, you might have assumed too much risk at that point. There's a fine line between observing things to see what's happening and to make good decisions. And the other side of that line is where you're just, oh baby, come on, just a little bit higher. Let's roll those dice and see what happens. The idea is to have the balance between the two. Prudent consideration should be made for how to fund a program. So it takes money to make money in the stock market. If you're going to use money to start an investment program, don't use borrowed money. Don't use equity in your house. Don't use money that somebody is willing to loan you. That's just my advice. What you should do is really think about this, because it's one thing to have a positive mental attitude and say, yeah, this is a really good opportunity and I really want to take advantage of this. Well, what if it doesn't work out? Not only have you failed at what you tried to succeed at, but now you owe somebody some money. Do you want to really assume that level of risk? And if you do use borrowed money, you think differently than if this is money that you can say, all right, yeah, I would like to have more, but if it's gone, I'm still going to feed my family. I'm still going to be able to pay my bills. And you have a completely different mindset. So think about that. And I'm not going to answer that for you other than what I've already said, but give a lot of consideration to what you want to do as far as putting money into a program, and how much do you want to put in, and how long can you keep the money in the program. So let's look at understanding risk. Everything in life has risk. We can't avoid it. Me sitting here, right now, there's a chance that an airplane could fall on me. There's a chance that where I'm at could blow up. Somebody could drive by with a gun and shoot. We hear about those things pretty much every day in the news. They're freak accidents. Well, freak accidents are because we live in a world full of risk. Some risk we can see beforehand, other risk we can't anticipate. For example, the same thing can be said about driving a car. Is a car risky? It kills a lot more people than COVID-19 or that guns do. Do we outlaw them? Kind of something to think about. If a person doesn't know how to operate a vehicle correctly, they could be at high risk not only to themselves, but to others at the same time. You need to learn how to operate that vehicle. If you don't know what you're doing, it's very risky. After you get some experience and some confidence in what you're doing, you don't even think about it as risk, even though you are assuming risk every time you get behind the wheel or you climb in a car with somebody else. A car is neither good or bad in and of itself. The car's not evil. The car's not righteous. It's not out to get you. It's not out to serve you and make sure you safely get to where you want to be. It's just something that we use to get from point A to point B. A car can be used for good, like going to a job or going to visit friends, taking somebody to the hospital. You could list 1,000 different things that a car is good for. It allows people to live in the country that used to have to live in the city. You can go on a pleasure drive. I don't know, gas prices are pretty high right now, so good luck with that. Or any number of different things that you can think about. Automobiles have become a fact of life, especially in the US. There are different places in the world where people go their whole lives and don't drive a car because they have public transportation. They live in a large city, and so they use other methods to get from point A to point B. But in the US, especially on the West Coast, where we have lots of open spaces, just to go to your neighbor's house may involve driving a car. Where I grew up, we had to drive a car just to get our mail. You couldn't really just walk down and pick it up. The mailbox was far away from the house. However, in the wrong hands, a car can be a weapon or very dangerous. Somebody that doesn't know what they're doing, they can really hurt themselves and other people. Every once in a while, a car will be used in some kind of a terror attack where it will drive into a group of people on purpose to hurt those people. Doesn't mean the car is evil or good. It means the person behind the wheel is doing evil things or good things. There are hundreds of thousands, if not millions of people killed each year in auto accidents worldwide. We have speed limits and we have safety measures and there are rules of the road. But I don't know anybody leading a charge to ban automobiles, at least the automobiles that we have now. Now, there is a movement on to switch the kind of fuel and energy that we use to operate those cars. It's better to look at the stock market the same way. The stock market is not out to get you. Nor does the stock market owe you anything. It's neither good or bad of itself. You may get in at just the wrong time and prices go against you and you think the whole world has conspired so that you're now losing money when you completely anticipated making money, and you might take that personal. Well, let me give you a word of advice. You're not the center of the universe. There are millions of participants each day in the stock market, trading trillions of dollars each day. And your little position, it's not that important. Just because you get in and it goes the opposite way, you're not that important to the overall effect of the universe. Now, I hate to break that to you because we like to think it's all about us, but it really isn't. You just had poor timing, or you didn't have good execution when you were looking to get into a position. But don't blame it on the stock market. It's very efficient. It has its rules. It's set up to buy and sell. It's not saying, oh, John's getting ready to invest, I'm going to go crazy now. No, there are other influences on the stock market that make it go up and down. The stock market is just a place. It's like going to a store and buying a shirt or buying an outfit. You don't like how you look in that outfit, so you blame the store. Something's wrong there. It's not their fault. You went in, you picked it out, you bought it, you put it on. You don't like it. It's not the store's fault. It's your fault. But they're still going to sell lots of those same clothes to other people who really like it. So it's not either good or bad. It is amoral. There's no morality attached to it. Yes, there are people that act in an immoral way that participate in the stock market. There are some very moral people that are participants in the stock market. The stock market itself, they've tried to make it as fair as possible for everybody. And so it's neither good nor bad. It's how the person uses it that determines if it's beneficial or not beneficial. Just like a knife. You can use a knife to cut your food. You can use a knife to kill somebody. What is your intentions using that particular instrument? If you get into a stock and you know it's a risky stock to begin with, and then you're surprised when it goes down, that just doesn't make sense. You knew that there was a chance it could go down. You were hoping it would go up. It ended up going down, and now you think the whole system is rigged and everybody's out to get you, and you're done with dealing with this whole thing. What you see now is just a chart of how we measure risk from left to right, and everybody's going to be a little bit different. And if you have to, pause this video and look at this, or find another chart similar to this, and then ask yourself, where do I come out? Over on the left-hand side where it's blue is low risk, and then you go all the way to the right-hand side where you have high risk, and then we have different categories for each one along the way, from conservative, moderately conservative, about in the middle would be moderately aggressive, to aggressive, and then very aggressive. I have all kinds in my program. There are some that really get a thrill out of being very aggressive. I have others that are way over on the left-hand side, and they don't necessarily want to make any money. They just want to protect what they already have. So they're very, very conservative with their investments. So where would you put yourself if you really honestly think about this in a sober way? And maybe ask some other people. Ask your spouse. Do you think I'm a high-risk person or a low-risk person? Another thing to think about is we would all like to have no risk and yet have a high return. It's not going to happen. There's risk versus reward. The more risk you're willing to take, the more potential reward you will have. So if you're going to invest in 3-month T-bills, your return is going to be way below even what the inflation rate is. It's safe and you will get that return. Is that really the best thing to do? We're way over on the right-hand side. You borrow money and then you leverage that money and you're in investments that you don't really understand and you're just rolling the dice at that point and you're hoping things work out in your favor. There's another thing that we like to look at. It's called a risk pyramid, and at the very bottom we have the green area, and that consists of government bonds, which are considered to be very safe. We can also call that debt because you're loaning money to the government. Money markets, which are very safe. CDs, notes, bills, and so forth. And then any cash that we may have on us. And that can include such things as a debit card. These are considered to be very low risk, and that should be the base of your risk pyramid. Then in the middle, you might have real estate, the house that you own, or maybe you own a different property, different mutual funds, or different stocks that you invest in, and then maybe some bonds that generate income. And then at the very top, you would have possibly some options or futures contracts or even collectibles. Maybe you're into art, or maybe you collect baseball cards, and you buy these with the idea of selling them in the future for a greater price than what you paid. These are considered to be high risk. Now, try not to put everything in life in this kind of a category. There have been banks that have gone out of business and people have lost their money, so that green area on the bottom turned out to be risky. There are people that buy a collectible and they don't really realize what it's worth, and it quadruples in value, and they're able to sell it, and they didn't really have to do much to see that return. And that would be pretty risk-free. Maybe it was given to them or they inherited it somehow. You can't really categorize everything according to this pyramid, but this is just a general rule to work from. You'll also notice that the bottom of the pyramid is bigger than the middle and the top. You usually want to put your less risky assets at the bottom and then have a less, but still a substantial part in the middle portion, and then you might take some chances at the very top. So how do we use risk when we're developing a strategy? And I have another video that I talk about developing that strategy, and risk will play a big role in that. The SPX investing program is the name of the program that I teach and that I offer people. And in this program, there are a lot of different strategies. Some of these strategies are considered to be very conservative. You just want to protect what you have. Or you just want to be able to buy something and then in the future sell it for a profit. Some of them may be more moderate. You're more in the middle layer of that pyramid. You're willing to assume some risk, but you don't want to live on the cutting edge wondering, oh my gosh, what's going to happen today? But if you are risky or aggressive, in the program that I teach, you can go to town. See, you can tailor my program to who you are. You can look at more conservative things, more middle of the road or moderate things, or you could just go cutting edge crazy if you want to. You assume the responsibility for that, which means that if you're right, you get to enjoy the benefits of that. If you're wrong, then you have to suffer the consequences and take that personal responsibility. Don't try going and blaming somebody else. What is considered conservative to one investor may be risky to another investor, and I've addressed that. Everybody's a little bit different, and we all have different risk tolerance levels. In a perfect world, it would be nice to take $100 or even $10 or $1 for that matter and turn it into $10 million in 2 weeks or in 1 day without any risk at all. That's really what people want. Why do you think the lottery is so popular? You take $1 or $2, plop it down, and you theoretically could get millions, if not hundreds of millions of dollars back. And people love to play the lottery. And they think it's harmless, and for the most part it probably is. But in everybody's heart, there's that desire to take a little bit, turn it into a lot, with no work, and relatively quickly. That, of course, is not going to happen. Yes, there are people that win the lottery, but are you going to win the lottery? Probably not. In fact, no, you won't. A person would have been better off by going to Las Vegas or going to a casino or, in fact, playing the lottery. You'll probably have more fun that way. Instead of taking some money, putting it into the market, sweating it out, and then losing, that's no fun. That's why a lot of people quit. That's why a lot of beginners don't last very long. Because they got in it with this idea and somebody made it sound so simple and they thought, oh yeah, this is pretty much guaranteed. It's going to happen. Well, when it doesn't happen that way, we're very disillusioned, we're very frustrated, and we just want to give up on the whole thing. Then the program that I teach, again, the SPX investing program, I help the people that are involved in that program to determine what strategies are best for you and then when to implement those strategies. That's a large part of what I do. I don't tell people what to do. I am a guide. I provide analysis and commentary, and I teach people skills with the idea that people take those skills, develop them themselves, internalize them, turn it into their own skill, and then develop their own program, whether it's based on different time frames or different risk levels. That is all up to you. If you fall into the trap of going to some of these get-rich-quick folks that say, yeah, just follow my program and after 3 weeks I'm up this amount, that's all bogus. Those are all lies. They're just trying to sell you a program. They're not trying to teach you anything. If they do tell you what to do, you haven't learned a skill. You're just knowing how to listen and act like a sheep and blindly being led to the slaughter. Or other times you may have some success. That's not the kind of program that I teach. And I've made it my mission in life to be the 1 or 2% of educators out there who really teach people skills and really help them to develop that skill over a period of time. I can't guarantee that you're going to make a lot of money. I can't guarantee that you will be successful, but I can guarantee in my program that I will give you the best information that I know how to give, and I will deliver it to you in the best way possible. And as long as you have a good attitude, I will work with you as much as you need to be worked with. How can we curtail risk? What are some ways that we can get rid of it, or at least subdue it so that it's not going to wipe us out if the bad things start to happen? It's impossible to remove all risk. We can never do that. However, some points that will help can include knowledge and teachability, and good books, good websites, good videos, good programs. I like to think that the program I have is the best one out there, so some of you might really benefit from that. Developing a working plan and a strategy. A lot of people have no clue what they're going to do. You have to develop a strategy, and please watch the video where I talk about that. And you have to practice. This carries over into all different areas of life. Do you think Michael Jordan was born the greatest basketball player? No. Do you think that a lot of musicians were just born being able to play the way they play? No. There were thousands, if not hundreds of thousands of hours spent practicing and learning and failing and trying over and over and over before they became good at it. And I address this in the workshop that I have that you can freely watch by just clicking on the link below this video. And diversification. So you may have a base with assets that are not considered to be very risky, and then on top of that have some more assets that are a little more risky, and maybe at the very top you might be willing to take some risk. And then respect for the markets. This is the big one as far as I'm concerned. A lot of people just think they've got it all figured out. Well, if they had it all figured out, why are they sitting alone in a room on a computer telling everybody what they're doing? I go to some chat rooms and I see some of the most hilarious, if not downright stupid comments made by some very clueless people. Please stay away from chat rooms, especially public chat rooms. They're just a complete waste of time, unless you want to see them as entertainment. But you have to have a healthy respect for the markets. It doesn't owe you anything. You're not the center of the universe. Anything can happen. And so you have to plan for that. And you have to have realistic goals. Remember when I said $1 into 10 million with no risk? That's not very realistic. But if you want to take a chunk of change and see maybe an 8, 9, 10% a year return, or maybe even a 20% annual return, those things are possible. They may not happen all the time, but they are possible. So you have to be realistic. And then flexibility. What if something's not working? What if you need to change some of your strategies? What if your life situation changes? You were single, you were developing a family, that didn't work out, now you're back to being single again, but you still have obligations. Things change in our life, and so your investing style may change along with that. There may be times when you have to take some time off from the markets. That's one of the nice things about it. Stock market will always be there. And if it's not there, we've got even bigger problems to worry about in the US. But maybe you want to take some time away. A lot of times people do that. They'll have a really good year and they'll say, okay, I'm going to take the next 3 months off or the next 6 months or the next year off. I just want to get away from the markets for a while and not worry about that. Or as things do develop, as your family grows, as your career grows, you may be able to get into different investments that you weren't able to get in before that. And then another thing, now I'm a person of very deep faith and I believe in prayer. And I'm going to end this video by sharing a Bible verse with you. My intention is not to insult anybody, but this is something I firmly believe, and I've seen it in my life and in other people's lives over and over again. Just give it a try. If any of you lacks wisdom, you should ask God, who gives generously without finding fault, and it will be given to you. Now, I don't see any conditions placed on that, other than the fact that you have to believe, okay, maybe there's a God up there, So if there is a guide up there, can you please help me out with this? I need some wisdom. It says you'll be given that. Just give it a try. And this is in James chapter 1, verse 5. Just see what happens. See if some situation that you're in, if you ask for wisdom, just see what happens. If it doesn't work, okay, that's the way it goes. If it does work, maybe you're on to something at that point. Don't go by what other people say. Put this to the test yourself and just see what happens. So thank you very much for taking the time to watch this video. I really appreciate that. Please click the like or dislike button below. Please leave any comments. Consider subscribing to this channel. That would really help things out. There's also the free workshop that I talked about at the beginning of this video that you may find helpful. Also, the public Facebook group where we just talk about the stock market and the S&P 500. We don't talk about cryptos. We don't talk about Forex. We don't talk about all these other crazy kinds of things. We try to stay on topic. And then there's also a blog that I have called spxinvestingblog.com where I have articles that I write that are pretty much similar to these videos, but my writing style and my speaking style are a lot different from each other. And some people like to read what I have to say instead of listening to what I have to say. So with that, thank you very much, and I'll talk to you in the next video.